Welcome to What's Not Priced In, a weekly investor podcast by Fat Tail Investment Research. In a world of confusion and rapid change, experts Kirill Prakapenka and Greg Canavan look behind the headlines to unveil the hidden opportunities within the Australian stock market. Now, let's dive into today's episode.
Earnings season is nearly over, but everyone is talking about inflation. The latest monthly CPI reading came in lower than expected, and the market reacted well. But is this warranted? And what's the bond market telling us? Yes, inflation is cooling, but at the expense of households. The US consumers running down their savings, and the amount Aussie households are putting into offset accounts is at multi-year lows. We then look at two big Aussie stocks, Harvey Norman and Brambles. Are both overvalued? Finally, we turn to the energy transition and its costs. Greg explains the importance of a vital concept, energy return on investment, and why it's so important for civilization. A low energy return on investment is a low standard of living. Hello and welcome back to the 15th episode now of What's Not Priced In. As always, I'm Kirill, and with me is the esteemed Greg Canavan. Greg, how are you?
Good, Kirill. How are you, mate?
Not bad, thanks. Not bad.
That's good.
Well, we've got a pretty nice episode for you today, and I hope humbly that every episode is a good episode. But today we've got inflation data coming out. We've got discussion on interest rates, and I think a very interesting discussion that Greg will have about the energy transition and maybe the costs that the market is maybe not pricing in. But I think maybe we can start with the latest inflation data that came out from the ABS, the monthly indicator. I think inflation did fall more than expected, which was good news. I think the CPI fell to 4.9% in the 12 months to July, down from 5.4% in June. That's great news. I think maybe less good news was obviously core inflation, which excluded volatile items like fuel and vegetables and fruit, was down a bit less. It fell from 6.1% to 5.8%. So core inflation is definitely still elevated, still a little bit sticky, but definitely it does seem that we are winning maybe the battle with inflation. And I think I'm a tennis fan. I think you're also a tennis fan.
Absolutely.
And the US Open is on, so maybe we can have a tennis analogy. So, our central banks up a break in the fifth set in the battle with inflation.
Maybe let's say third set. I don't know if we're quite close
set.
to.
Wow. Okay. So that's okay.
Well, see, this goes back to the higher for longer argument that we've been talking about for some time. Yep. In that, I certainly think inflation is coming down,
yep.
And I don't think it was ever going to be as persistent as a lot of people thought. Mm-hmm. And if you look at where inflation peaked at the end of last year, it has come down significantly. And as we've spoken about previously, that was mostly due to the supply shock. And then we had a huge increase in demand because the government put so much money in people's pockets. You had a big increase in demand. You had a big reduction of supply. Of course, that's going to mean a huge price surge. So we're coming down the other side of that line now, and third or fourth set, maybe it's 2 sets to 1. Okay. Probably not quite in the fifth set yet. But yeah, there's been some good tennis. I'm marveling at how good Djokovic is at the age of 36. The precision of his hitting, he is, he'll probably go down as the greatest of all time. And then you've got the young gun coming up, who is absolutely insane for his age. So really looking forward to those guys. I don't know if you saw the Cincinnati final a couple of weeks ago between those two, which
I was following it live. Yep.
Probably one of the most intense games of tennis I have ever seen. And for people that don't really follow tennis, I came late to it in life. I grew up playing rugby league, which is just a bit of a meathead team sport where you just, you try to build each other. Whereas tennis is a physically demanding sport as well as nearly 80% mental. Mm-hmm. And if you have two players that are equally as proficient at their shots, as equally as fit as each other, the person with the mental strength will win easily. And it is just such a fascinating sport to watch when you understand that mental side of it. And my daughter's been playing for nearly 10 years now. She's only 14, but she's been playing since she's 4. And a lot of the stuff that I can't really help her with too much tennis stuff, but I help her
Yeah.
with a lot of the mental stuff. And there is a big parallel with financial markets and the way that you need to be mentally strong when you're getting signals from one part of the market telling you one thing, but you know you need to resist that and react against that. So, bit of a diversion to what we're just talking about, but yeah, I can talk about the parallels between tennis and markets, for quite some time. So it is definitely an apt metaphor, and I think it's why tennis is such a globally popular sport, because it just speaks to everyone, and people that really get into it just find themselves quite addicted to the battle. And when you see good battles out there, which that Alcaraz and Djokovic match at Cincinnati was an epic battle. It's just compelling watching. So, but where were we? We were talking about inflation. You were right.
Inflation,
I think
interest rates. Yep.
the
What's the
market
market thinking? Yep.
The market reacted pretty positively to that number. So even though there are indications that inflation is coming back down, and that's taking the pressure off the RBA and whatever the Fed Reserve to continue raising rates, you're still going to have rates higher for longer, because inflation is a lagging indicator. So even though we are seeing the signs of weakening demand now, you're not going to see that necessarily flow through to the inflation figures for a number of more months, and potentially not until the end of the year. And if you just look at say, for example, the electricity prices that came through in that CPI, we had a 6% jump in July alone, and it would have been nearly 20% jump in July alone without the rebates. Now, I know that that's a resetting of prices as each year these prices do get reset, but it just goes to show there are a lot of structural things coming into play now with inflation that we need to keep in the back of our mind. And that speaks to the idea that we're not going back to those really, really low interest rates previously. And I think the next thing I'm looking for is to see, as the economy continues to slow, as the money runs out for consumers and belts are tightened further, you're going to see, I think, bond yields rally. You're going to see inflation continue to fall on the back of that weakening demand, but it will probably trough at a higher level than what it has in the past. So this is where you're sort of starting to get that idea of structural inflation, not necessarily being high like it was in the 70s, but just being higher than what we've previously been used to under the QE environment and under the near zero interest rates that we had for much of the past decade. So I think that's going to play out. And I'll just quickly, we can quickly have a look at some of those charts just to show you what I mean when it comes to that. So if we look at this was the chart I mentioned last week. So in last week's episode, for anyone who missed it, we discussed the fact that there was an article from the San Francisco Fed they put out, and by their estimates, the US consumer will have run down its excess savings. I think they said by the end of this quarter, so by the end of September. So we're looking at a relatively short period away from all that excess spending from the pandemic and from all the money that the government put into the economy. That will be run down by the end of this month. And then I mentioned that a similar thing was happening in Australia, and this is a chart that the RBA put in their latest, I think it was the statement on monetary policy, goes only to the end of June, so it's a quarterly sort of update. But as you can see, this is redraw and offset accounts, the extra money that has gone into these. And clearly around the COVID times where people had a lot of additional money going into their accounts, that all went into offsets and redraw accounts and looked quite healthy. But as you can see here, it has really dropped quite sharply. And now you're getting to a point where the share of disposable income going into offset accounts and redraw accounts is below 1%. And the last time that happened was back in 2018-19. And I'm pretty sure back then that was when the Fed had to stop raising rates and had to cut rates, and the Aussie economy was slowing or quite weak as well. So this is a sign you would imagine that this would continue to fall in the next couple of quarters. So it's just an indication that yes, it is continuing to be tough out there, and we've got a few stocks we'll look at in a minute in relation to the health of the consumer. And if we just look at, so this is a bond fund. It's one of the bond funds that I've recommended to my subscribers, but it is just a bit of a proxy for fixed income markets. And you can see that it's been in this very long sort of basing pattern over the past best part of a year. And throughout this time, people have been very bearish on bonds. And even up until quite recently, when bond yields broke higher again, there was a lot of negative commentary around bonds and fixed interest. But if you look at this chart, it actually looks quite constructive. You've had this sort of really decent low put in here. We had a move higher, then another correction back down, and we're looking like we're basing and trying to form a higher low around this level. So it is starting to pick up again, and that's just an indication. I might just get rid of this RSI so you can see it a bit better. It's an indication that, perhaps we have seen the lows for bonds, and they are starting to move higher. I think one of the things that you probably just need to consider, and maybe the market is being a little too optimistic, is that on those inflation numbers, when they came in better than expected, the market put in a big rally. Now, that was probably a bit of short covering. Maybe some people were positioned differently for the release, but it goes to that sort of almost knee-jerk reaction that lower bond yields mean lower discount rates, which is good for asset values. And that can continue for a little while, but I think at some point the market says, oh, hang on, bond yields are going down because inflation is slowing, because the economy is slowing, and that's not good for earnings. And at that point, you sort of get to a situation where you think, okay, well, falling bond yields are not necessarily compatible with rising equity prices as well in a slowing environment. And if we just look at the tips here, these are the inflation adjusted bond prices. So they're effectively a reflection of the real interest rates. And at their lows, it's an inverse. So at the lows of tips, it means we're up towards the highs for real bond yields. So we're still looking quite high in terms of real bond yields, which means they're sort of restrictive in the US. We have seen a little bit of an uptick here in the past couple of weeks, and that's coincided with the rally in bonds. It's also coincided with a rally in the gold price. So as you can see, the gold price has corrected lower here over the past couple of months. It's made a lower lows here and lower highs. So really you want to see this rally take it to a new high above this level, just to sort of get a bit more comfortable that the correction is over. Alternatively, you might see another little correction here, and you'd want to see that low hold. So with gold, it sort of rallied briefly just because of the brief rally in the real yields. But I think it's a little bit too early to talk about whether that might have bottomed. But certainly it's sort of looking reasonably good that you're seeing gold supported here, because it fits that argument that the economy is slowing, bond yields are coming off, real yields are coming off a little bit as well. And if that continues, I think that will be a positive. But just more broadly for the market, we're just seeing this same pattern that's been in place for some time. You're seeing sell-offs followed by rallies. We're recording this on Friday morning, so the market hasn't opened yet, but it's due to correct about 30 points today. I think the futures are showing, so we're going to get a little bit more weakness, and it's just this long, drawn-out period of not much happening on the headline index front, which can be quite frustrating. But underlying that, as we've talked about in previous episodes, there's a lot of stuff happening under the surface with individual stocks, especially over reporting season. And we mentioned that in last week's podcast. The quality stocks have done really well and getting into expensive territory, whereas the ones that have disappointed being sold off heavily, and that's uncovering a bit of value.
Yeah, definitely. I think while the stock index itself has been pretty flat, there's been some pretty wild stock moves in individual stocks. I think Appen was probably one of the biggest ones, that it fell about 32% on the day of its release. The AI boom clearly didn't arrive for it, and the soft guidance suggested that it wasn't really coming anytime soon. So that was disappointing. But I think something that you said was, and I think we've mentioned this maybe a month or 2 months ago, which was that a lot of, I think, maybe investors are happy to hear that inflation is coming down, but they sort of stop there instead of sort of realizing that the reason inflation is coming down may be a lot more, I guess, negative than they realize. If
Yeah,
inflation is falling because consumers don't have enough discretionary funds to spend on anything, that's quite bad for earnings, and that's not good for the stock market. So, yes,
absolutely.
it's great for central banks that they're maybe getting on top of inflation, but if they're getting on top of inflation by restricting the economy, that's not really good for stocks.
Exactly. And it depends how much is priced in. And we saw
Yeah.
over the course of the earnings season, consensus estimates have come down
Hmm.
to the point where I think numbers for FY24 on average are now 5 or 6% below FY23. So we are seeing that priced in a little bit,
Hmm.
but it all comes down to the individual stocks. And we are seeing lots of movement between, as I said, and we talked about this all of last week, quality stocks are
Yeah.
now getting to the point where they're quite expensive, and the lack of quality, in many cases, that's deserved. But I think there's a lot of probably good stocks being put in the penalty bin
Hmm.
that may not necessarily deserve it. And one of the things I always talk to my subscribers about is if you want to buy a cheap stock, you're not going to get into a rosy scenario.
Hmm.
You're buying into uncertainty, and
Yeah.
uncertainty is what produces the value. So if you want certainty in your investing portfolio, you're going to have to pay up for it, and that can work well
Hmm.
for some time. But if any disappointment to the growth or anything like that comes through, then those stocks will be punished as well. So it's and that's why I like to look around for uncertainty.
Hmm.
And sometimes you can be underwater for a little while when you first buy into a situation where there is a lot of uncertainty, because that
Hmm.
scenario can continue for months longer. So
Yeah.
you might have to put up with that uncertainty, that nervousness, and that feeling that you've made a mistake and that you've gone into early. All those things are part of the mental game of investing. It's like,
Yeah.
hitting double faults, hitting into
Yep.
the net, playing long, all those sorts of annoying things. And you've just got to, I guess, do your homework, make sure that you're looking at the numbers, making sure that what you have paid is a reasonable price.
Mm.
And intrinsic value is obviously, your estimate of value is obviously higher than where the market is. And if you can build in those margins of safety, it gives you a little bit of comfort to get through those periods where the market's disagreeing with you.
Yeah. And I think maybe an example of that sort of uncertainty and then a turnaround, I think, is EML payments. I think it's done really well over the last 52 weeks, I'd say, after getting belted because of some dodgy dealings with its subsidiary, I think, in Europe. And I think now sort of the market is sort of realizing that at its core, it's a solid business. And I think now it's sort of moving away from the more dubious subsidiaries. And I think now it's also got some, I think maybe it's a takeover target as well. So it's done really well. But there was a period where no one wanted to touch it, and now it's soaring. So
And
that's
they're the
one.
really hard ones to work out, right?
Yeah.
Because if companies have got into problems because of bad management
Mm.
decisions, then it makes it difficult to buy into that
Mm.
management who have made those bad decisions. So their underlying business might be good,
Mm.
but if you're a bad manager, you can destroy value in a good underlying business. So
Mm.
they're the really tricky ones. But it also goes to show that sometimes the way that share registers exist in businesses is quite interesting, because there can be a whole bunch of shareholders that are in a
Mm.
company because it's going up in price, and they don't really care about the value. They might like the story. It might be a
Yeah.
popular stock. So you've got all these short-term investors in. When that turns south, they didn't care about value
Mm.
on the way up, and they don't care about value on the way down. So they might just get out, and it takes sometimes a long
Mm.
time based on the liquidity of a stock
Yeah.
for all those shareholders to exit. And that can keep pressure on a stock price for a long time. And then you get to a point where, uh, I guess in technical terms, it's called accumulation. And then there's a
Mhm.
new bunch of investors that come in because
Yeah.
they see the value and they're accumulating the stock. And that creates a base in the share price. And then they're set and they're holding the stock. So it takes a new bunch of investors to come in on potentially new and positive news that comes in and pushes that share price higher, because those people that have come in and accumulated the stock, they're not selling until it gets a fair bit higher. So the other psychological aspect is trying to understand who is in the stock and why they're getting out, and maybe they've bought up here and then mental state is quite damaged because the share price is down here and they just want to get out at any price. And that's the reason why I really value technical analysis, is because it actually gives you a bit of an illustration as to how that process is playing out.
Yeah. And maybe that happened to quite a few local Aussie stocks, Aussie lithium stocks, where I think a lot of people got in at the high and then the lithium stocks went nowhere and then declined. And then people just tried to run for the exits at any price, really. And a lot of stocks.
Absolutely. And when those stocks trend down and then there's a short-term rally, people just see that as an opportunity to get out at a better price.
Yeah.
I wanted to get out. I'm just going to get out now. And that's why you can see those trends down, up, down, and it just takes a while to really sort of get that feel for when that process might have played out. And combining the fundamentals with the technicals is a good way to help you do that. But I've been doing it for 20 years and I still get it wrong.
Well, like we said, I think last episode, it's okay to be wrong, but not to stay wrong. So do check that episode out. But I think you sort of mentioned quality companies and maybe the fact that at these uncertain times, people do pay a certainty premium. So maybe we could look at two quite big, solid run companies in Australia, Harvey Norman and Brambles. I think Harvey Norman released its full year results, and as expected, obviously, revenue growth wasn't as strong. I think the most interesting thing, which sort of ties into our discussion about the the strength of the Aussie consumer, Harvey Norman gave a retail trading update for the month of July and compared that to the month of July last year. And for the Australian franchisees, sales are down 12%. And I think in Northern Ireland, sales are down 20%. And in all of their other segments like New Zealand and Croatia and stuff, they're also down. The only one that showed any growth was in Malaysia, and that was 0.6%, which is negligible. So clearly, Harvey Norman is definitely suggesting that the Aussie consumer is curbing its spending. And that's not really great news.
It's not, but it's not necessarily unexpected news either. And I think that's one of the things that people always need to keep in mind is was the news factored in previously? And I've just brought a chart up here of Harvey Norman to show this. And obviously, this is when things were getting very negative in the market. A couple of months ago, there was a lot of concern about the health of the consumer. Harvey Norman's share price broke below this sort of long-term support. So from a technical perspective, that's a really negative sign. But it quickly rallied back up above there. So that was almost like a false break. That shook a lot of the shareholders or investors out of there. So the numbers that have come through were actually a little bit better than expected for FY23. I think the market expected 40 cents earnings per share. Harvey Norman reported 43 cents. But for FY24, the expectation is that earnings will fall 30%. So there's not a lot of, certainly not much positive expectation priced in. And when the numbers came out yesterday, clearly that wasn't priced in because we've had a nice rally there. Now, as to whether you'd buy Harvey Norman here, my sort of preference would be, I just think there's better opportunities out there. And this is a really good example of, I think, where the market's at the moment. So, and especially if you're one of your strategies is to try to combine the message of the technicals with the message coming from the fundamentals. So when Harvey Norman broke down here, from a technical perspective, it doesn't look good at all. But from a fundamental perspective, I mean, all around this area, Harvey Norman was looking reasonably decent value. I mean, the yields were quite strong. You might not necessarily be getting a lot of growth, but you're going to get some income. And if you can buy it at below intrinsic value, that's probably not a bad play. But the technicals were telling you that's probably not the right thing to do. So now if I put the numbers into the model, and we've discussed this model on previous episodes, and you and I both did it independently, and we both came up with a intrinsic value of around about $4.20 using an 8% discount rate. So it's a little bit below there at the moment. Would I be buying it, it's probably not enough margin of safety, and especially given there is just a lot of uncertainty. And even though a 30% decline in earnings expectations is considerable, we are coming off very elevated rates of spending for household consumer, just all sorts of consumer goods. So, I probably wouldn't have enough confidence in those numbers and in the forecast and in the business itself. And there's various question marks over Harvey Norman's business. I know that a lot of analysts are not fans of how they how they do their accounting and all that sort of stuff. And not to, don't mean to cast aspersions, but I know it's not, it's quite a polarizing company in the analyst community. So I just wouldn't say it's got enough of a margin of safety for me to invest in. And if I look at this overall trend, I think at best it sort of probably goes up to these highs and maybe turns back down again and just sort of trends sideways for some time. Don't know what your thoughts are on it.
I think it will also probably most likely trend sideways from here because I think it's just profitability is normalizing rather than improving. I think it had a great few years that I don't think will be repeated anytime soon. And I think its average equity in full year 23 was about 4.38 billion, and on its full year net income, that's a return on equity of about 12.5%. And I think during the accounts, Harvey Norman constantly stressed that, hey, don't look at last year, compare us to full year 19, because that's clearly was the favorable contrast. But if you look at the return on equity in full year 19, it was 13%. So profitability is clearly
it's about the same.
Reverting to the mean. So I think it's probably fairly priced, and it's probably not going to go any higher from here. Yep. But you also did a valuation of Brambles, and I think this is also a really solid company, delivered a pretty solid result. Sales revenue on a constant currency basis rose 14%. Underlying profit also rose about 19%. But I think management did say that in the second half of last financial year, as anticipated, there was evidence of destocking across manufacturers and retailers. So I think Brambles sort of supplies pallets for all of the logistics, and it did see that its core customer base was sort of curbing that spending back.
Yeah, it's all about the movement of goods, right? But the result was reasonably good. I think they demonstrated pricing power, which just goes to show the quality of the business. So the pricing power offset some of that weakness in volumes. But as you can see, the share price here has done really well over the past 12 months since it's bottomed out there at the end of 2022. So it's really, really nice upward trend there. Clearly, the result was better than expected. It saw the share price surge to new highs. If you look at Brambles' FY24 numbers, they're on 18.2 times FY24, 3% yield. So the yield's not too much, but that's because they reinvest nearly half of their profits back into the business. So there's obviously the growth angle to it. But looking at those numbers and the consensus for FY24, I get a valuation of around about $13.30 on the stock. So there is a bit of a quality premium priced in, which is probably fair enough. And if you've owned this stock for some time, you probably want to keep holding it to see where that trend takes you. But in terms of a new position, it's probably not something I'd be too keen on.
Yep. I think it's sort of this idea of a quality premium or a certainty premium. I think it's definitely an interesting idea that has legs. I think a few weeks ago I ran some valuations based on your return on equity valuation model on the top 3 stocks in the ASX, which is BHP, CSL, and CBA, and all 3 of them were not quite overvalued, but they were definitely overvalued by 10% or so. So there's definitely in the top end of town a premium that investors are willing to pay because they're probably just happy for the certainty.
Oh, absolutely. And I think that's just another indication of this idea that capital is flowing up into the largest companies where there is earnings certainty. And it's just another reflection of the psychology of the market at the moment. And you are seeing a lot of nervousness out there, even though the index itself is not necessarily showing anything. It's just a sideways moving market. But I think again, a reflection of that money moving into the large caps, which is effectively holding up the indices. Whereas if you look down in the small caps and the world of micro caps, there's a lot of carnage down there in the smaller end of the market.
Yeah. Well, speaking of capital and capital flows, I think now we'll turn to a very
capital destruction.
Capital destruction, yeah, which is all about the energy transition. I think you just recently released a very, very nice report on this issue. And so why don't you just really take it away?
Yeah, I thought it's worth mentioning, and we won't sort of dwell on it for too long here, but for those who watched the various episodes of this podcast, we have had a series of bonus issues called Net Zero Insanity over the past few months, and I've been interviewing a range of people to try to get a different take on what this energy transition is, why it's happening, what it's going to cost us, and that stems from my long-held view that this will be a lot more expensive than what we're being told. It's going to take a lot longer than what we're being told, and it might not actually work. And part of the idea behind that is that how best to put this? We are transitioning for the first time in history to a less efficient form of energy production. So the report that I wrote for subscribers a couple of weeks ago, or last week, I think it was, sort of detailed the history of our first energy transition. And we went from feudal and agrarian societies burning wood, we moved to coal, and the technological change that came out of innovations in the coal mining industry kicked off the Industrial Revolution, which is still considered like this massive change in the way that we lived and massive change in wealth and prosperity that we as humans have enjoyed over the past 200 years. And one of the key ideas behind that is we went from wood to coal to oil, which are all more energy dense forms of energy. And we are now reversing that, going to wind and solar, which are less dense forms of energy. And it's going to cost us more, and it's going to lower our standard of living because we need to invest more of our resources in producing our energy. And to me, it's just insane. And I think we have been told over and over that this transition must happen because we have a climate emergency, and there's more awareness being raised and more scientists putting up their hands saying, I'm not sure about this climate emergency. Is it really, or is that just what we're being told in order to justify this expensive transition? Speaking of expensive, we just found out yesterday that Snowy Hydro is now going to cost $12 billion, not $2 billion. Now, that is probably not necessarily new news. We've known about the blowouts in Snowy Hydro for a while, but it just goes to show those costs are increasing. That doesn't include the transmission that needs to be built to connect Snowy Hydro to all the renewable energy areas that are being built to obviously pump the water back uphill. And AMIO came out yesterday with a dire warnings about how we're going to get through a traditionally hot summer, which no doubt we'll hear about the hot summer as being a result of climate change coming up, because we are going into an El Nino pattern, which is a different weather pattern that we've had for the past few years. So the energy market regulator is now talking about, the operator is now talking about the risk of blackouts, especially in South Australia and Victoria. And South Australia, of course, is the poster state for renewable energy. And partly the reason is because our coal-fired power plants are getting so old and we haven't invested in new capacity for so long that we're getting to a point where the unreliability in the coal-fired fleet is a risk, because we're just not creating the new capacity to compensate for that. But before I go on, I just want to highlight something that I wrote in this report, just to sort of give people a sense of why this is so important. So when I spoke about the transition from wood to coal, Britain was the first country to do it, in that it had plentiful reserves of coal, and it enabled it to do it, and it enabled it to be the first to benefit from it. And I wrote that Britain was the first nation to shift to a more energy dense form of fuel. It didn't reap the benefits of that shift immediately, but over time, the investment paid off massively. It became a modern superpower on the back of cheap, efficient, and abundant energy. America's subsequent rise to global superpower occurred on the back of the transition to oil, a more energy dense fuel than coal. Moreover, it was abundant and cheap to extract. The US also benefited from vast reserves of natural gas, which was the next energy source to be exploited after oil. So, if you look at the history of, I guess, economic dominance that we've been used to in the West, especially, it largely comes down to our ability to harness those energy reserves and produce enough that goes on to save us time, to come up with other innovations and create higher standards of living. Now, the idea behind that is a concept called energy return on energy invested, and the idea there is that you need to have a decent level of energy return on energy invested in order to sustain a modern civilization. Now, this concept, which we'll just call EROI, this concept was introduced by an ecologist called Charles Hall. So I'll just read a little quote from the report, because I think this is really important, for Australians to understand as we're sort of hearing about the transition that we're going through, how much it's going to cost us, but more importantly, what that will mean, not necessarily next year or the next 5 years, but in the decades to come, and for our kids and grandkids, and what they're going to inherit from the decisions we're making now. So it says, ecologist Charles Hall invented the concept of energy return on energy invested. He believes the metric is crucial because it helps us to see which energy sources are high quality and which ones are not. Using this concept in a 2013 interview, Hall explained how the moves to renewables might not be able to sustain our civilization. This is a quote from Hall. We looked at the minimum EROI you need to drive a truck, and you need at least 3-to-1 at the wellhead. Now, what that means, just to interject there, is that in order to justify bringing a truck into the oil field and trucking it out, you need an energy return on energy invested of 3-to-1 to even get that done. And he says, now, if you want to put anything in the truck, like grain, you need to have an energy return on energy invested of 5-to-1. And that includes the depreciation for the truck. But if you want to include depreciation for the truck driver and the oil worker and the farmer, then you've got to support the families. And then you need an EROI of 7-to-1. And if you want education, you need 8 or 9-to-1. And if you want healthcare, you need 10-to-1 or 11-to-1. Civilization requires a substantial energy return on investment. You can't do it on some kind of crummy fuel like corn-based ethanol, which has an EROI of around 1-to-1. A big problem we have facing the alternatives is that they're all so low EROI. We'd all like to go toward renewable fuels, but it's not going to be easy at all, and it may be impossible. We may not be able to sustain our civilization on these alternative fuels. So he was saying that back in 2013, before it really became a hot political issue, which it is now. So just on that, there's an interesting chart that came out that shows the various fuel sources. Yep. Now, I'm not sure if that has come up for you. Can you see that chart? So solar, biomass, which is effectively, things like burning wood and probably cow dung and stuff like that. Wind, solar, thermal, they are all the lowest form of energy return on energy invested. And this is from a 2018 study, I think it was. And when we're talking about, just to explain what the chart means, unbuffered versus buffered, buffered is even lower because it takes into account the intermittency of these energy sources. So the return on energy investment that you're getting from these, and look, they may have been updated from those original studies and they may be a little bit higher, but you're not getting enough return on energy invested in order to sustain a modern civilization that we are used to. And this is why the concern is that our living standards are under major threat. Whereas if you look at traditional fossil fuels, natural gas and coal, hydro is obviously up here, but we can't build a hydro dam everywhere. They are a lot higher and they are able to sustain our standard of living. Whereas if we look at nuclear, this is modeled on a nuclear power plant in Germany. That is the highest energy return on energy invested that we have. So it just goes to show the insanity of the debate at the moment is that we're not even entertaining nuclear in Australia because Chris Browan says the costs don't make it worthwhile. And I'm actually interviewing someone which we'll have on this podcast in the next few weeks that has dug into the gen cost modeling of nuclear versus renewables and found some major flaws in it. So I'll be getting that interview to you soon, hopefully. And just to finish off on the topic, this just goes to show this is global primary energy consumption by source, and that's not just electricity. This is energy consumption. So we've got coal, oil, and gas taking up a huge portion of our energy needs, whereas wind, solar, hydropower, other renewables, and things like that, still a tiny amount. There is no way, there is absolutely no chance that in the next 20 years or 30 years, by 2050, we are going to get to a point where all these account for all these. It's just not going to happen. And it just, and I think, part of what I'm trying to do on this sort of bonus series is make this discussion not a political discussion. It's an economic discussion about, are we doing the right thing for this in this country for our future generations? And we are absolutely not. It's going to create some major issues. We're already plowing billions into it, and it's just that so many people stand to benefit from it and couldn't really care less about the future, because they're going to make a lot of money in the next few years by getting on this renewables gravy train. And probably just the final thing I'll say on it, as an anecdote about the efficacy of this or not, you probably saw yesterday in the Fortescue Metals update, yet another executive has left the building. And to me, that just really suggests that there's some really loose thinking going on there about this energy transition. And maybe Andrew Forrest has completely drunk the Kool-Aid on it. And the executives that are coming in there are saying, seriously, I'm not hanging around for this. This is not in my best long-term interest. And, money talks in many different ways, but money also talks because of reputational risk. And I think a lot of people questioning the ability of Fortescue, to continue making good money, because they're transitioning from a very profitable iron ore company to some form of future energy, hydrogen business. And Forrest himself has said he's willing to accept lower returns. I'm not sure if the shareholders will be happy with that, but it just, to me, it just suggests this whole debate is really sort of heating up at the moment, to pardon the pun. Didn't even mean to use that, but the whole debate's just getting crazy, and more people are coming to realize that what we're being told by our politicians and our regulators and the bureaucrats that are pumping out all this information is actually not necessarily true. And the more people that question it, the more people that understand it, I think the better off our long-term future will be.
Yeah, and I think given the Reserve Bank, the incoming new governor, Michelle Bullock, she gave a speech, I think, earlier this week, titled Climate Change and Central Banks. And she was sort of outlining that there's the physical risks from climate change itself, and also the transition risks, which I think is what you're sort of talking about, which is the world's reaction to climate change and sort of what the investments that the world makes. And she did say that, for example, this is her quote: depending on how this transition plays out, if the net effect is to temporarily lower aggregate supply, and she was talking about lowering the aggregate supply in terms of phasing out carbon-intensive production, then she said this would put upward pressure on inflation. And then she also said that there is much uncertainty about how we will phase out our coal-fired power plants. And she said Coal-fired power plants are scheduled to be shut down over the next 3 decades. This could put upward pressure on energy prices if coal plant closures are not matched by renewable supply and storage. There is much uncertainty here. Yeah.
Thanks for the revelation. It's hardly surprising. We're trying to electrify our economy.
Yeah.
We're trying to shut down our baseload power and replace it with renewables that are taking a long time to be built, are taking a long time to be hooked up, and are not going to replace that lost capacity. So we are trying to increase demand and a shrinking supply at the same time. What's going to happen to prices? It's going to go up a lot. And that's the problem. We are investing more of our resources in building an inefficient energy capture and transmission system. And if we, had a sensible discussion about nuclear, I think our future would be a lot more secure.
Yeah. Well, on that happy note, I think we'll end the discussion there. But definitely check out. I think that the bonus episode will come out soon with your interview.
Actually, we've got one coming out. We should have one coming out with Dr. Ian Plimer next week. So I had a really good chat with him about a lot of these issues, and then that will follow with more in the weeks and months ahead.
Yep, but yeah, do let us know what you guys thought of this episode and what your views are on the energy transition in the comments below, and leave a like, subscribe, and all of that jazz. Beautiful. Greg, it's been nice talking to you, and see you next week.
You too, Kirill, and thanks for watching, everyone. We'll see you again soon.
See ya. Thanks for joining What's Not Priced In, your weekly source of unique ideas in the Australian stock market. Now, if you've enjoyed this episode, please show your support by liking and subscribing, and turn those post notifications so you don't miss a thing. And stay tuned for the upcoming episodes as we delve into new topics, new trends, and new stocks. Thanks for your support. Hope to see you next week.